last year might have a sense of déjà vu about this panel, because we were talking about a similar subject with these two esteemed members of the global monetary scene a year ago. So it gives us a perfect opportunity to check in on the future for inflation, but as we were just discussing, the future of inflation to some extent is the future of the global economy. So welcome, gentlemen. Nouriel, let me start with you, because I know that you're always so upbeat in your prognostications for the world. Since we last met, the Federal Reserve has raised interest rates about 8 times. When we were last here, the federal funds rate was still at 1%. It's now over 5%, potentially at a peak, certainly we think it may be taking a break. Have they done too much or too little?
First of all, a great pleasure being back here in Qatar. Great honor again to be with you, Governor. I think they've done a significant amount, but my view is that for a number of reasons, inflation is going to surprise on the upside, both in the United States and in Europe. Labor markets are very tight, unemployment rate at historical lows. There is aging of population, restriction to migration. In the US, collapse in labor force participation rate, the great resignation, and now there's the beginning of labor strife. So wage growth is excessive. There are geopolitical tensions in the world that are going to fragment the world. They may lead to further spikes in commodity prices. The Fed is not done yet. Even in June, we may have another hike, and certainly the ECB has much more work to do. So I think that the tightness of the labor market, the existence of geopolitical stuff, deglobalization, other factors imply that inflation is going to be more persistent. It's falling, but not fast enough. And therefore, central banks are going to face a dilemma, or better, a trilemma. They want to achieve price stability. They want to avoid a hard landing. They want financial stability. But if they have to raise rates more, as I expect, to fight inflation, eventually there may be a hard landing and financial instability. And if they care about growth and financial stability and they don't raise rates enough, then there's a risk of a de-anchoring of inflation and inflation expectations. So I commend them for what they've done. I think that the big challenges are going to be ahead of us.
And Your Excellency, you face, I guess, a second challenge in the sense that you have to assess the current outlook for inflation and how the Federal Reserve is approaching it, but also have to consider whether the link with US policy, the peg with the dollar, is still the right one for your country. So how are you seeing it?
Yeah, thank you for having me. Actually, as you mentioned, that Qatar currency is pegged to the US dollar. And we believe that this policy is appropriate for Qatar economy, and we don't see an immediate need to change that policy. As my colleague here mentioned about the inflation, yes, globally, the inflation last year, many countries have experienced their highest level of inflation for many decades. However, we have witnessed in the last few quarters that the inflation, there was an improvement in the inflation level. It's affecting, yes, the global growth. There is no doubt about this one. But we have now to balance between the price stability, growth, and financial stability. So central banks over the world have no other option other than to bring the inflation to its target level, because we do believe that inflation is the enemy of the economy, and the inflation is going to hurt even household pockets. So inflation is in downward trajectory, but what we are seeing now is a sticky inflation, and it's going to decline, but at a slower rate. And it will take a long time in my forecast until it reach the central bank's target level.
And can I just follow up, because we just wanted to clarify something. At the time, around the period of the last Federal Reserve interest rate hike, your central bank said it was holding and then retracted and decided to raise the 0.25 percentage point. So I just want to make sure I understand, what was the thinking there? What happened there?
Yeah. As I mentioned before, that we are pegged to US dollar, and we are taking our decision accordingly to US Federal Reserve decisions. And our decision, what we take, it's what is appropriate for our economy. So there was no doubt that we will increase our interest rate during that time.
So there was just
no, It was a media mistake. It wasn't the decision. So
right.
Our decision is to increase. As you know, U.S. Raised their interest rate, and sometimes we have hold our interest rate during the increase. We narrowed the spread between U.S. and Qatari deposit rate, the QMR deposit rate, to 25 basis points, the spread right now. Before it was 100 basis points. And we see it's useful and it is effective for our economy at this time.
Now, Nouriel, you make an argument that many people make, that looking at the stickiness of inflation and the suggestion that probably the Federal Reserve will have to do more, and I think certainly the European Central Bank will have to do more. The argument that one would hear, particularly perhaps from those in the financial sector against that, is that there is a credit crunch building, a delayed consequence of the many, many rate hikes we've already had, which is going to have a bigger than expected, is going to have a longer term impact on activity, on lending, on small businesses, job creation. Is there a risk that you're underestimating the problems that are building on the credit side?
No, I do agree there will be a credit crunch, and that's going to slow down economic activity. But even there will be a slowdown of economic activity, labor markets are so tight that you need an outright economic contraction for creating enough slack in labor market to slow down wage growth. I also think that the geopolitical factors are going to be keeping overall not just energy but also commodity prices higher. And I think we're too much thinking about the short run. If you think about the medium term, the reason why we had low inflation in the Great Moderation was not just because we had inflation targets. There were a series of positive aggregate supply shocks that lasted for decades. Trade, globalization, China, Russia, India, emerging markets, joining the global labor supply, production of goods, services, commodities, weak labor, technological innovation, migration from south to north, a geopolitical peace dividend that helped stabilize the world. And now we have a series of just reverse, medium, long-term negative aggregate supply shock. We have deglobalization and protectionism. We have reshoring of manufacturing and friendshoring rather than offshoring. We have aging of population, advanced economies and emerging markets. We have restrictions to migration. We have a geopolitical depression that's going to fragment the global economy and decouple and lead to balkanization of global supply chains. We have the effects of global climate change on both energy prices and on food prices. As we saw, COVID-19 leads to stagflationary shock that increase costs and reduce growth. This is not going to be the last pandemic. We have cyber warfare. We have a backlash against income and wealth inequality. And now where there is a weaponization of the US dollar, is leading to gradual de-dollarization. These are all factors that are reducing potential growth, increasing cost of production, and they're all negative aggregate supply shock that are going to keep inflation higher. So it was easy when you had positive supply shock to have inflation. Actually, inflation was too low. The world is very different, and that's are the structural factors that are inflationary and stagflationary over the medium term on the supply side. There are also factors on the demand side.
Your Excellency, Nouriel's just given a very good description of the many, many ways the world has changed. And we've been talking about that also in the last 2 days, how much the global economy has changed and indeed changed in its approach and the money flowing and interest flowing in this region, have all those things changed, and yet it's still appropriate to have the same peg, the same setup for monetary policy in Qatar?
Yes, as I mentioned earlier, we are pegged to dollar, and we believe that it's appropriate for our economy, and it's been very effective and efficient for our economy. As well as the IMF and their reports have mentioned that and highlighted that the pact is appropriate for the GCC countries. And our main revenue is in dollar. Our main export is energy, and the main revenue is in dollars. So it's very appropriate policy to have to keep our currency pegged to U.S. dollar. And we do believe that U.S. dollar will remain as a primary currency for international trade settlement due to its global acceptance, stability, backed by a strong economy in U.S.
But just to follow up on that, I mean, many would say that the environment for the dollar has changed quite a lot. And there's certainly a lot of discussion in this region and globally about reducing the use of the dollar, less confidence in the stability of the US, for sure, given the politics that we've seen over the last few years. And even the Made in America policy might have implications for the level of the dollar and the commitment to keeping a strong currency. So do you not think any of those things should make you think about a changing role for the dollar in your economy?
Yeah. Stephanie, each country has its own sovereign decision. We have heard from time to time in the news that two countries, they came together, or some other countries, they came together and signed an agreement to exchange trade in their local currency. And this is, I believe, a sovereign decision. For us, we still believe that our peg to dollar is appropriate for our economy, and we don't see any immediate need to change that policy, since it's very effective for our economy.
Nouriel, where do you stand on this, about the future of the dollar, but also its the broader impact on the global economy? Would we be in a better place in a few years' time if the dollar was waning as a reserve currency?
Well, until now, the global currency system, reserve system, has been unipolar, and the US dollar is the disproportionate currency as a unit of account, a means of payment, as a store of value. But I think that the US cannot take it for granted. You have twin fiscal and current account deficit. There's a risk of rising inflation and debasement of fiat currency. There has been a weaponization of the US dollar, maybe rightly so, for national security and foreign policy purposes. The Chinese are worried that eventually there could be a freezing of US Treasury held by China. The same thing has happened with Russia, and therefore they're building a role for the RMB as being a reserve currency, as a means of payment. They've gone to the region and they've told Saudis and others, why don't we start paying you in RMB? Why don't you build up your dollar reserves? Why don't you change your peg? So far, that's not happened. I agree with the governor that pegged to the US dollar and having the dollar has been a source of stability for the region is going to remain. But I think that the US cannot take for granted that emerging markets, the Gulf and so on, are going to take the dollar and maintain the dollar as a major reserve currency or means of payment. I think there is a meaningful risk that inflation is going to be higher. It'll be the basement of fiat currencies, and therefore we have to change the international monetary and financial system in a way in which dollar assets have to be backed by something, either by real assets or financial assets or something more to give a little more credibility. Otherwise, gradually over time, a process of de-dollarization may occur, and we may move from a unipolar regime to a bipolar one, in which the RMB is going to become an alternative US dollar as a reserve currency. It's going to be a process, it's going to take time or decades, but I think that you cannot take it for granted. You know, a few years ago, Larry Summers joked and said that, well, you cannot replace something with nothing. And he said, Europe is a museum, China is a prison, Japan is a nursing home, and Bitcoin is an experiment. But in the last few months, as you have seen, the talk about the de-dollarizing, emerging markets saying, why should we keep the dollar from Brazil to those in Asia, even talk within the Gulf on whether we should think of US as being a credible strategic partner, whether we should keep on using US dollar. So I think the US has to think seriously about how you maintain a system that is going to be dollar-based but safer and more stable than the current one. So changes will have to occur over time.
And many years ago, you and I both worked for Larry Summers at the US Treasury when, as we were just pointing out, the US debt was falling and we were paying off debt. Now we're arguing, or in Washington, they're arguing over debt. Just briefly, how does what you've just said, the path of the dollar and the credibility of the dollar, how is that affected by the debt ceiling battles?
Yeah, as you recollect, we're during the Clinton administration where with budget surpluses, the supply of treasury was falling. We're even discussing what will happen in a world in which there is not anymore enough treasuries. Now the problem is the opposite. We have twin current account fiscal deficit. The stock of US debt is rising. There is a problem with the debt ceiling negotiations. These deficits are going to become larger and larger. As central banks are doing quantitative tightening, their demand for treasury is going to fall. And with geopolitics now, central banks around the world, certainly among those who are rival of the US, are moving away from dollar assets into gold or other ones. And therefore, there'll be upward pressure on the financing costs for the United States. Even today, the dollar being major reserve currency, financing costs in the US are much higher than Europe, much higher than Japan, and much higher than any other advanced economy. I think the trends of debt build up in the US are going to imply that regardless of what's happening with the debt ceiling, the issue of US not having any more that exorbitant privilege is going to become a key question for financial markets and the treasury markets in specific over time.
Now, Your Excellency, as well as being a central banker, you have the benefit of being one of the world's biggest fund managers as chair of the Investment Authority. The world that Nouriel has outlined, is that a world that's good for investments? How are you seeing the next year and the plans for the Investment Authority?
Yeah. I believe there is always an investment opportunity. And yes, I do believe there's an investment opportunity even in this environment, which is a challenged environment. However, we have to do the right due diligence, diversification across assets and economies, as well as the right assessment for risk and return. If you have done this process, I believe that you will find the right investment opportunity. So there will be always an investment. Investment will not stop, but the right due diligence, diversification, and risk and return is very important, especially during this time.
Do you worry, a lot of fund managers I talk to, they talk about a brighter future ahead, but a big adjustment that has to happen before then as assets are marked down and we absorb the impact of moving to higher interest rates. And the venture capital industry is one area where there are some concerns about overvaluations right now, and you have some exposure to that. Are you concerned about that?
I'm not concerned about that because when we go through any investment, we do the right due diligence and we make the right assessment for risk and return for that investment, and we put all the scenarios in place. So in investment world, you have a process before you do your investment decision. If you have done it properly, then you will be in better shape. We have a large portfolio in QIA, Qatar Investment Authority, and very well diversified across assets and also across regions. And we have a very limited exposure to affected assets. So I think we are doing well.
And Nouriel, just to finish with you, and I hope I might be able to extract a positive word out of you, although I know it sometimes is a struggle. But there is a view that says, yes, it's bad that inflation has been sticky. It's hard to bring inflation down. But the other bit of news in the last year is that the economy has been much more resilient than we thought. You know, along with the stickiness of inflation has been not having a recession in many parts of the world that we thought might already have had a recession, the US, Europe. We're now taking off those forecasts off the table, at least for now. Do you not think that we have learnt something about the underlying capacity of some of these countries in the last year? Maybe some positive news about potential growth? Or are we just building up bad news for the future?
No, you're right. But to build resiliency, in my view, you have to deal with the supply side bottlenecks that are going to be constrained to economic growth. Therefore, there is a huge need to invest into infrastructures, both in advanced economies, emerging markets, and the region. We need to do the green transition. It's going to imply significant investments into a variety of renewable energy and other alternatives. We have to build communities throughout the world to make them more resilient for the geopolitical changes are going to be occurring. We have to invest, for example, into not just energy and renewable, but also in green metals and other industrial metals, because the supply right now is limited. And if we want to do the transition and avoid greenflation, we have to do those types of investments. We have to invest into safe assets, and traditional safe assets like long-term treasury are not going to be safe anymore. So I do believe that we can deal with the challenge of maintaining economic growth and controlling inflation. The bottlenecks are on the supply side, and any types of long-term investment is going to lead to reducing these supply bottlenecks, including avoiding excessive decoupling, excessive fragmentation, excessive balkanization of global economy is going to be important. So it's going to be up to strong leaders in the region and around the world to make sure that the assets and the surpluses are being invested into real investments and financial investment, both in the region, in North America, around the world, to make sure that we're not going to face a trade-off between growth and inflation. Can be done, but you have to take the long view in terms of investments.
That is an excellent place on which to end. It's all down to you and anyone who's able to seize these opportunities, and then we can grow and avoid some of the more gloomy scenarios. Thank you very much, both of you, for an excellent discussion.
Thank you.
Thank you.